Wow, the last couple weeks are just chock full of data. The economy's changing, the world is changing. Let's go to my very first slide, and we're going to talk about the economy. Look at what's going on. The Atlanta Fed is saying that the economy has dropped down to next to nothing. Now, as you know, I thought we were at an unsustainable level with the economy. And a lot had to do with the fact that we went into this recession. We got a lot of money put into the economy. The economy exploded. It went to such a level that we just couldn't maintain that. And we started to reside and slow down. Now you can see this is quite a bubble that took place. And look at right here. We're talking about something that's really dropping. And a lot of this has to do with the supply chain. You hear in all the news everywhere, you can't hardly miss it, the fact that we're missing computer chips. But the computer chips aren't the only thing. We're missing like dishwashers and refrigerators and air conditioners and switches for the wall plates. All kinds of product we're missing. Everywhere you look, we're missing parts, and we haven't got enough to complete whatever it is we're manufacturing, and it is slowing the economy. Now, based on that, we're talking about raising interest rates, and we have had interest rates come up a little bit in the last 3 or 4 weeks, and the Fed is talking about raising rates. But now look at the Fed. Here's what we've been talking about is that the Atlanta Fed is saying we're going down to next to nothing, and the Federal Reserve is saying we're going to hike interest rates. Well, that's happened a couple times before, and what happens? The economy really slows, like you put on brakes, and that's really not what the economy wants to do. So maybe the Fed is making a policy mistake. Now here again, we're looking at the U.S. Composite PMI, the Purchasers Managers Index, and it's come down to almost 0, which means, again, it's kind of confirming what's going on in the Atlanta Fed, is that the economy is starting to slow and slow a lot. Now, that means the growth is slowing. We still have a fairly good economy. It's just not expanding and it's not contracting. It's just coming down and leveling off. Now, bears watching, because if this continues and we start to contract, then we're going to go into a different mode than we're looking at. Personally, I think that the economy is still going to be contained, and I think it's going to do fairly well. Now, this is business activity. This is again from the Purchasers Managers Index, and we're looking at the Services Index, and the Services Index is doing very well. Now, keep in mind, 50 is kind of the benchmark. So if you're above 50, the economy is expanding. If it's below 50, it's contracting. Typically, it only goes 3 or 4 points one way or the other. So if we had a 52 or 53 or 54 on the PMI, that's saying we're doing very well. So you can look for the January business activity. We're doing 51.2, a fairly good and reasonable reading. And we're looking at service industry, so not the manufacturing, not the industrials, but the service industry is doing very well at 59.9. Now, again, this is a very strong reading. I wouldn't look for that to stay there, but nonetheless, it's telling us that in the services, the economy has no problems whatsoever. Where we're having problems is in the manufacturing industrial portion, where we're having difficulty getting all the components. Here's a manufacturing. We just got this slide from Zero Hedge. Manufacturing contracted. Now, that just means it's slowed down, and it's slowing down, and it's contracting just a little bit, but it's still at a very positive reading of 13.3% year over year. So it's showing us that we're in very good shape. We're coming down to a more sustainable level. This is obviously a pretty sustainable level. We've had very good readings until just now, and it's just contracted just a little bit. Certainly not cause for alarm, but at the same time, if we start raising interest rates, in other words, the Federal Reserve wants to slow the economy down, when the economy is already slowing, it would seem to me that they probably missed their window to do that. And the economy is doing it on its own. It's starting to contract, but just a little bit. Here's something that's very confusing, and this would concern me. Now, we just saw that the economy is starting to slow, and it's starting to actually just contract just a little bit. We've got 2 different types of job payroll numbers, December and January, we've got unadjusted numbers, and we've got seasonally adjusted numbers. Now, the unadjusted numbers show a huge, enormous job loss of 2.8 million jobs. 2.8 million from December to January unadjusted. That is an enormous amount of jobs that lost. Now, if that's true, then we are really slowing down a lot faster than we think. If they adjusted it, in which they're saying a seasonally adjusted, so they're saying that, well, we want to smooth the data out and put it into our model, and the model shows a gain of 467,000. So this is a very, very confusing data point at this junction. December showing a 2.8 million jobs, adjusting it showing a 467,000 gain. So again, this is confusing. We need to keep our eyes on it. If it continues, then we really have an economy that's slowing quicker than we think now. But what's going on in the economy? You see truckers aren't able to deliver. You've got Canada, they've got a trucker strike, and they're doing protests, so nothing is moving. And of course, Canada is one of our big suppliers and one of our big trading partners. So you know when they don't send stuff down to us, you know they're a big meat and packer, and they send down raw meat, and we pack it. If they're not sending it to us, that's just loss of jobs. So maybe that's part of this. We're going to know in probably 30 or 60 days. I think we're still fine, personally. Here's what we're taking a look at is that commodities show no sign of abatement. We're showing that prices for commodities continue to rise, and they're approaching peaks that we saw in 2008 and 2011. I think we're going to go way above this. These are not inflation-adjusted dollars anyway. So even if they were the same, even though we've lost, you know that we lose money on our even with only a 2% inflation rate, this would mean that by the time inflation adjusted, this would be much, much higher. So I assume that this is going to go much, much higher than these two, but the direction is still up. So real assets like commodities, and we're not talking just about industrial commodities here, we're talking about soft commodities as well. And we're talking about iron ore and copper and aluminum, but also soybeans and corn and wheat. And, so when wheat and corn start going up, and I hear we have shortages in corn, that means the feedlots have to pay more for corn, and that goes through the economy. So right now we're showing commodities are continuing to rise. So let me go to my next slide. Now again, we're looking at producer price index. So right at the very base, this is where things start. This is why we talked about a year and a half ago, we could start seeing that the producer price index was starting to rise, because that's where all the commodities start flowing into the system. And you can take a look at this right here. Now this is based over a 100-year, 110-year chart, and you can see that we've had continuous inflation come through here. Now this is when we came off the gold standard, we started having inflation. And right here, look at the producer price index. It has just spiked like nobody's business right here in the last year and a half or so. Again, it's confirming on commodities on another index that there is no slowing for the prices for commodities. And here's what is the result of all this. So we start to see commodities rise. And of course, we're talking about gasoline and fuel. Now we're talking about a barrel of oil is running at around $90 a barrel. We use petroleum in everything from fertilizer to plastics and of course diesel fuel. And when you have diesel fuel is going to doubled, why of course then all the costs of transportation is going up. So, and this is a global phenomenon. Here in Europe, it's up to 5.1. It's almost 14% in China. Even Korea is seeing it. So it's a global phenomenon. We're seeing inflation everywhere. A lot of my clients have done very, very, very well in the stock market. Now, again, we never advocate that you put all of your eggs in one basket. We don't tell you should have all your portfolio in real estate and in rentals. We understand that you want to have other asset classes, but a lot of my clients are way over invested in the stock market. And when you look at this, I'm going to tell you that we are at a stock market valuation that's 70% more expensive than the dot-com bubble, which means that the valuations are at extremes. Now, what happened when the dot-com bubble burst? Well, I'm going to tell you, I remember this. So the NASDAQ dropped 78%. So if you're my client and you had a lot of money in the NASDAQ, you weren't very wealthy anymore. Your whole life got turned upside down. A lot of people sold when they could, booked those losses instead of riding it out, and it just changed their lives. Now you have an opportunity here where you've had these enormous profits. Look at this. I mean, we have historical valuations. I'm not telling you to sell all your money, but it might not be a bad idea to take a little bit off the table. Look what happened when the dot-com bubble burst to home prices. This is coming out of the Federal Reserve electronic data system when the dot-com stock bubble burst. And you can see it, that's the shaded area here. This is when we went into recession. Housing stumbled just a little bit here. It didn't really stumble, it just kind of smoothed out. This was a terrific housing opportunity, a buying opportunity for housing. But as the stock market was dropping 78%, housing never did. It slowed the rate of increases here. It slowed the appreciation rate. It didn't go negative at all. And then it took off and just started going. So housing is oftentimes counter-cyclical. So remember, housing is a completely different asset class than stocks, different asset class to bonds. And there is very, very little correlation. So if the stock market just has enormous problems, like you can see here, when the dot-com bubble burst, housing was totally unaffected and actually started to increase because when you spend your money and you have this capital needs to go somewhere, so came out of the stock market and went into housing, another asset class. Same thing happened with the corona. Now we talked about that. We had talked to Charles Nenner. He was very, very concerned in our interview. Then the economy went into recession, stock market dropped, the economy just collapsed. And what happened to housing? Again, the rate of appreciation increased. Actually, it was counter-cyclical. Just like we've been telling you from time after time after time, when the economy slows down and the economy hits a big bump in the road, housing often takes off because it's countercyclical. It is a completely separate asset class. And look at housing. It just took off and it increased and increased. And this is what's going on. And it's showing the same thing is going to happen. It's going on with commodities. Housing, of course, is a commodity. What do we make housing out of? We make it out of lumber and asphalt shingles and plastics, all kinds of metal and steel, aluminum and iron ore. And all the base metals are going up, and it's driving the price of housing up. Now, I know the interest rates have come up a little bit. They look like they're talking about raising interest rates again. Historically, it's still cheap. I mean, historically, rates at this level of 4s, even into 5s and 6s is cheap. You have to remember during the great financial crisis, during the bubble, I was there. You know, Phoenix was the poster child for the housing bubble. Interest rates were between 5 and 7% at that time, and people were buying left and right. Prices were going up. So we're not as interest rate sensitive as you really think. We're seeing that rents are going up, and they're following right along with housing. So if the economy slows, it may become a huge buying opportunity. You may have just a small window before we go into the explosive phase. And this is a great buying opportunity for you. Now, I understand it's going to be a little scary. Remember, when we buy properties, we have a pretty long-term horizon. We're looking at these for 4 or 5 years minimum. A lot of properties in my portfolio, I've had way longer than that. I had them 30, 35 years. I've got families in my properties that have been living in my home for 15 years. It's their home. I own the property, but it's their home. We don't want to disrupt them, but they've been there all that time. So this is a really, really long-term hold. So if you get a buying opportunity looking into the future, when you're looking right into an inflationary spike, it might not be a bad opportunity for you to take a look. We have been telling you and telling you and telling you that if you just have 2 properties, just 2 rentals, going to make a huge difference in your life, particularly if you're a baby boomer. Now, we're in the real estate business. We're here in Phoenix. You can buy in your own hometown. Here in Arizona, we have an exodus coming to us from California. They are leaving that state, voting with their feet, coming here to Arizona, driving our prices right up through the ceiling and driving rents up, bringing all kinds of jobs. And it's just been an amazing, and it's a long-term trend. So it's a great place here in Phoenix for you, but just start with 2. I would like you to have 10 or 20, but just 2 is going to make a huge difference in your life. If you like my videos, again, give me a big thumbs up. You're welcome to subscribe. You can support me by buying my books, by How to Create a Real Estate Money Machine and Retire with Income, because you're going to retire at any age once you get financially free and you have income coming in. And then when you retire, we need to think of what's going to be our income source. Real estate rentals is just a great asset for you to have your money in. And if you're just getting into the business and you're just starting to think about this, real estate investing for beginners is just great for you. If we can help in any way, you're welcome to reach me at michael@michaeldouville.com. You're welcome to come here to Phoenix. We have classes, we have seminars, we do conferences. We'd love to see you and come shake our hands. So if you need me, you can reach me at michael@michaeldouville.com.